I'm an accountant and I refuse to accept that business owners have to have a poor quality of life and be stressed. I've seen that when you don't use digital systems, it's harder to see the data and what's going on. In my earlier videos, I talked about how you can digitize your business processes from paper receipts to digital and modernizing your sales processes to take advantage of automation. As an accountant, I've seen it when clients only look at their bank accounts and don't know their margins or profits. I've seen clients measure performance on turnover instead of profits, and I've seen the stressful situations when a client hasn't been able to see what to save for their taxes and they don't have enough cash. It doesn't need to be like this. If you're new here, hi, I'm Antonia, or welcome back. I'm a small business owner and an accountant. I own Abacus Jack with my business partner Andy. Our mission is to enable business owners to make better decisions with recent financial data that aligns with the business owner goals. If you're here to pay no tax, you're in the wrong place. But for everyone else, in this video, I'll show you how to leverage the data from your bookkeeping software to take control of your cash flow. Together, we'll cover how to calculate and save for your corporation tax and self-assessment tax. Then we'll talk about a quick month-end routine for peace of mind. To estimate your self-assessment and corporation tax, I'm excited to show you how we're going to do this using the data that we've already put into Xero. We're going to start with corporation tax, as we can save that from the business bank account as a business asset. That means we get a business savings account, or we use a savings base or a pot in our current account. Xero doesn't calculate corporation tax automatically, so there's a few steps that we need to do, but don't worry because these are straightforward and repeatable, so you'll get used to them. To understand how much corporation tax you need to pay, we're going to have to get that information from Xero and then make some adjustments in Excel. This is because in Xero you might have explained some expenses as expenses which will show us deductions on the profit and loss account. However, not all expenses are allowable for tax, such as depreciation on assets and also any business entertainment costs. So what we'll need to do is add those back on, but we'll go through that now. So first we're going to go to the P&L report. We want to check the date range here to make sure it's in line with the financial year that we're in. So you can see that our financial year ends in a couple of months in March. So we're going to look for our profits so far to see if we've saved enough money for corporation tax so far and make an estimate of what we need to save going forwards. So this is what's loaded. And we can see we have an operating profit here of 17,534. We can see here that we have some business entertainment costs of £44.66. And we need to add back £44.66. So as our profit is less than £50,000, that means that we get access to the 19% corporation tax rate. In the UK, depending on the level of your profit, will affect how much corporation tax that you have to pay. So if your profits were over £50,000 but under £250,000, then you get what's called a marginal rate, which is a rate in between 19% as the lower rate and 25% as the top rate. 25% is reserved for people who have profits over £250,000. So to work that out, you can take your profits and put it into a gov.uk calculator and they'll tell you which rate to use as an estimate. Now we can just use the 19% rate because the profits are under £50,000. So if we go back to our calculator amount where we've added back the entertainment expenses, we can times this by 19%. And that means we're going to expect to pay £3,340 of corporation tax. As the date that we're using only takes us to the middle of January, then we're still missing 2.5 months of data. So we could then use this to estimate the tax if we're assuming the level of income is going to be fairly stable over the next few months, just to give us a rough estimate of what the corporation tax savings need to be. So if we divide this by 9.5, 12, we could estimate that our total for the year is going to be around 4,200 in tax. So you could check, have you got any money saved up at the minute, or if you have been saving, is it towards this level? Remember, when you reach your year end, you do have 9 months afterward to save up for that corporation tax if you need it, so don't worry too much. Another way to do this is if you were gonna try and save up month to month to see what your tax needs to be, then you can go through each month in a healthy sort of financial wellness routine and check what your profits are per month, and then you can save that much into a savings account each month. Or if you have the full year estimate, you can divide that by 12 and then transfer that same amount into the bank account each month, and that should get you fairly close as well. But if you wanted to do the monthly way, then we just change the date range here to the last month, we update it, we get a profit here, we check for anything that needs to be added back in, we add it back, and then we apply the 19% again, and that will give you something to save at the end of the month. So generally, as a good rule to follow, if you set some time for your financial wellness routine a couple of weeks after the month end, then you can review the previous month, and then you can make any admin adjustments that you need to, such as saving money into the savings account for the corporation tax. That should mean if it's a couple of months after the month end, if you had any invoices that were outstanding, they might have been paid then, and that might help with the cash flow as well. Next, let's talk about self-assessment savings. So this one is a little bit different because when you talk about the business bank account to the personal bank account and the personal liability, they're two separate legal entities. So we need to be careful about if we're withdrawing business money to pay for personal tax. What I'd recommend really is you look at how much your taxes are going to be, and each month when you receive your payment into your personal account from your business account, that's when you skim the money off for your personal tax. How much you need to save depends on how you take your income out of the business. So from a tax efficient point of view, if you're a business director, you probably mix how you take the income between pay as you earn monthly payment that's declared through pay as you earn, like a salary, and then a dividend top up. If you take the same dividend each month, then you can estimate the tax on that and then set up almost like an automatic transfer to skim the tax off of that into your savings account or your pot or your space. If you're not sure what dividends you've taken, then you need to go into Xero to your accounting menu and reports and look for the chart of accounts report. In there, change the date to be the tax year, which is the 6th of April 2024 to the 5th of April 2025 for this tax year, and then search in the list of transactions to the dividends. Sometimes I just type DIF and then press it, and that'll bring up the account that it's been reconciled to, and then you can see what your level of dividends is for the year. Let's run through a quick example to explain that a bit better. So if you know the plan for your income, for example, you're going to take around £1,047 per month as a wage, so that you use your personal allowance up, then that's 12,500 per year. If you then take £2,000 dividends each month, then that'll be 24,000 per year. And if you add them together to get your income for the year, then that income would be 36,570. Based on the UK tax bands, your income would all fall into the basic rate of tax. Dividends run on a different set of tax rates compared to normal income. If we take the £24,000 you received as a dividend, you can then take £500 off that because you get that as its own separate dividend allowance, which is tax-free. Then there's 23,500 left that needs to be taxed. So the basic rate of tax for dividends is 8.75%. So that works out to £2,056 of tax annually, which is £172 a month. So every month when you get paid by the company and the money comes from the business bank account to your personal bank account, what you need to do is skim £172 out of that net pay and put it into a savings account, and that's your savings for your self-assessment tax. If your income was going to be over 50,270 when you add everything up, then your dividends are going to end up in the higher rate as well as the basic rate. So you'd need to split the amount that was taxed at 8.75% and the rest is taxed at 33.75%. So at that point, you can estimate your tax, probably using something like a GovUK calculator if you need to. And then from there, you can work out how much you need to skim off each month. And another thing to watch out for are payments on account. A payment on account is a prepayment for the next tax year that you have to pay if your tax bill is over £1,000. If this happens, then you need to save a bit more for your first year. This is because normally you save up each month, then pay the balance by the end of January. But if you have payments on account, you're actually paying a year and a half in that January. Let's go through an example for that one. So if in the tax year 22-23, your tax bill was £800, then your £800 bill would be due in January 2024. You get your next tax calculation for the 23-24 year, and you've earned some more money, so your tax has now gone up to £1,200. The amount due in January 2025 is now the £1,200 for the tax year before, similar to what happened last time. However, you now have a payment on account that you need to pay as well. This is because your tax bill was over £1,000. The amount of the payment on account will be half of the previous tax year's liability. So 23-24, the tax liability was £1,200, and that's why payments on account kicked in. The payment on account is half of that tax, so £600 will be the payment on account, and this will be a prepayment for the 24-25 tax year. So by the 31st of January, your bill will actually be £1,800, not the £1,200, and this is because you're paying £1,200 for last year plus £600 for next year. When you get to July, you'll have to pay another £600, and that's called the second payment on account. So when you get to the next January after that, when you've done your 2 payments on account, and we're now in January 2026, you've already paid £1,200 towards your tax for this year. But your earnings have gone up again, so your tax bill was actually £1,400 for how much you earn in the 24-25 year. So what you get then is a balance in payment of £200, plus half of that tax again, which would be £700 because that's half of the £1,400. So what you have to pay in the January is now £900. If you have a year where you think your earnings are going to go down because expenses have gone up and you haven't got as much profit, then you can apply to reduce your payments on account by logging into your government gateway account for self-assessment. Okay, so we've already covered how to calculate your corporation tax to help you save for it, how to calculate and plan for your self-assessment tax, and the impact of payments on account and how they may affect you. Finally, let's talk about a quick month-end checklist that you can use to save you time and stress. We're going to check money in, money out, and then see if we can move towards any of the goals that we've set. Assuming we sent all of our sales invoices out from Xero last month, we want to go in and check that everyone has paid who was meant to have paid. So we're going to go into the accounting menu, then reports, then age receivables. So at the end of last month, we had one person who owed us some old debt. We're going to assume that these are going to get paid in the next couple of weeks and keep an eye on them. So for City Limousines, we can click on their record. This gives us a statement of their account and what they owe. So we can click export down here, get a PDF or an Excel, download that, and then we can send that on an email to the client and say, hi, please can you pay your invoices? They're now overdue and you're in breach of your payment terms. So that's the sales side of things. We can then go back to reports, and this time we're going to look at what we need to pay someone. So just change that to the end of the month. So we have some old debts here that we need to pay out. So we know Xero is going to be on a subscription. Let's change it to today. We still haven't paid central copiers, so we want to make a payment to those. So if we're not sure what we need to pay, we can click here and see what the invoice was for. And it was invoice 945. So we need to make payment to those, and then we'll have more of an accurate cash position of where we are for the month. And we do that for each one that is due payment. Then we would go and run the routine that we did earlier. So we go back to reports, have a look at the profit and loss. Estimate what our corporation tax is going to be, make sure that we've saved that money. And then we can do a little bit of performance analysis. So we can use this compare menu to compare with 3 months. So looking at this, we can see how we performed compared to previous months, and it looks like our sales are going up. We're starting to have to buy stock, which is normal. We've spent a lot of money on advertising. So at the bottom we can see we have been profitable, which is good because the month before we were in a loss. We're less profitable than October with less sales. So what we need to focus on at the moment is controlling the expenses. So is there a way that we can level out the purchases for stock so that they're not all in one big hit? Or is there something we can do to reduce the spend on advertising? Rent is pretty standard. And general expenses have doubled, so probably want to keep an eye on that and just make sure that we're controlling those within a budget range that we're happy with to keep an eye on profitability. Okay, so now we looked at a business goal, which might have been changing the stock purchases to be smaller amounts throughout the year rather than one big hit at one point in the year, or potentially controlling how much we spend on general expenses. Also putting a budget in there for the advertising to make sure that doesn't get out of hand. But what about a bigger goal now? So what about something you as a director wants to achieve? Like, what have you got for the vision this year? So is there anything personal that you want to achieve? Spending some more time with your family, or is it saving up for some personal activity that you want to do? So can you afford a bit more dividend this month so that you can save that towards the family holiday this year, something like that. So it's important that you look after you as well. Make sure you have a list of things that you want to achieve, and once you get a handle on what the goals are for the business, make sure you pick one or two of those things that are important to you as well for you to focus on. Thank you for joining me today. I've loved sharing these financial tips to help you get more value from your data. We covered saving for tax, creating a monthly financial routine, and how stepping back from the day-to-day to review your numbers can strengthen your cash flow and drive your business forward. If this video was helpful, please give it a thumbs up and subscribe to our channel for more business tips to help you hit your goals. More subscribers means that I can create even more content, so share this video with anyone who it might benefit. If you'd like to apply these tips to your business or explore becoming a client, check out the links in the description below to book a meeting or connect with me directly. Don't forget to follow me on Instagram and Facebook for daily tips. Thanks again for watching. See you next time.